Ladies and gentlemen, welcome to the study. Going to be talking about the United States credit rating. Why am I talking about US credit rating and not stocks? Well, they're actually all related, and there is a big developing story taking place on Capitol Hill regarding the issue of the debt ceiling, where the United States government is expected to run out of money by October 18th. So, how does this all come together? Let's say, for example, you have somebody that you lend $100 to, right? And they are expected to pay you back that $100, correct? If they don't pay you back that $100, then what does that do to the relationship between you and that person? You have to really think about that because it makes an impact. Then what is the likelihood of you lending $100 again to that person if they weren't able to pay you back the initial $100 that you gave them on the first go around? Kind of the same picture here, and that's pretty much the idea of credit. Getting your credit score higher means that you have outstanding credibility, and on top of that, you're going to have more access to capital and funds and resources. And this is something that the United States consistently has been able to do without any issue. Raising the debt ceiling, making sure that they have cash available, making sure that they're able to pay down any obligations. And why this is so important and how it can impact the stock market is that if you're not able to pay out any of these payments, you essentially are destroying your status, your credit. So this is just a tool I have here on Trading Economics website that shows the different agencies that give out different ratings. And you can see they have AAA here from the Fitch agency and a negative outlook moving forward, which was recently issued. But across the board, if you look here, you have Moody's, S&P, Fitch, all across the board, these agencies that have been around for quite some time that established these credit ratings with different countries in the world. You can see that the U.S. has done very well, and they have excellent credit. Now, if we were ever to default, which we have never done before in history, then that would throw a wrinkle in the mix, and you have to start thinking about different payments that may not, the government may not be able to make, such as for tax credits, pension funds, all kinds of stuff. It becomes a domino effect, really. It has a big impact on the loans, borrowing costs, those kind of things. So how does this translate to the stock market then? Very simple. It impacts trade, global trade. You're not going to have as much money in the system to be able to facilitate larger trades. And that reflects on the stock market as well. The confidence goes down. Investor confidence goes down. That is not good. As investor confidence goes down, less activity in the market, less money that is in the market. So that means stock market would ideally, in theory, go down. So you could be playing a trade here or setting up for an opportunity with the upcoming deadline, even though statistically we have never had this issue before, but you can't rule anything out. You always need to have a plan in place. That's what I teach everybody. Have a plan A, plan B. Make sure you're ready to go so that there's no surprises and you're not shocked. No emotions involved. None of that. You're going to execute the plan depending on the outcome, and that is it. So, very cool website, recommend it, tradingeconomics.com. You have these resources here, and if you scroll further down, you can see the different countries and their different ratings attached to it. You also have these different scores. Moody's has a different format for the rating system. S&P has a different format. Fitch as well. So you got to make sure that to actually go into the details and learn how to read these ratings. I mean, some of it's pretty straightforward. If you have an A, that's good, and B is okay. You want to be in the A. A is greater than B. The 1 is greater than 2, those kind of things. They actually have an explanation all the way down here on the bottom. Here you go. See, if it has a AAA, that's a prime excellent rating score. High grade would be AA1 under Moody's. If a company has AA3 versus AA1, AA1 would be better. Upper medium grade would be A1 instead of AA1, A2 instead of AA2. And it has the rest of the pattern here. Also has a pretty good description of their Trading Economics own credit rating score, how they calculate a credit worthiness of a country, where they use a scale of 0 to 100, 0 with the likelihood to default, 100 meaning that there's not going to be that much risk of a country going into default. So, just wanted to do a quick video on the United States credit rating history, why this story has become so big and very important, and politics has pretty much taken the front stage in the stock market right now, just because we have to figure out this money situation where the government is on the verge of running out of money. And it can be considered a global event and have an impact on the trading markets. If they are able to resolve the issue and extend the debt ceiling and get some extra funds going, that will be excellent. Then the government will be able to fulfill these obligations, these payments that they have to make, and they won't have to default on them, which would then provide the risk of not paying out those payments. So guys, if you enjoyed this video, make sure to leave a like and subscribe. If you have any questions, visit me at www.thetradestudy.com, leave a comment below, and I will see you in the next one.